Hello, fellow Westover clients. I am coming to you today to talk about the kind of problem we all should have, which is paying capital gains taxes for capital gains enjoyed. It's tax season. It's a few days before we will be filing on April 18th for our tax return for 2021, and we've been getting a few calls from clients surprised at the size of the capital gains their portfolios enjoyed and the consequent tax that they now owe. Like I say, it's a good problem to have, and I wanted to explain to you how we got here, what we're going to do about it going forward for your information and notification purposes, and hopefully assuage any concerns that you have about that issue. So let's put it in context. The tax that you pay is called a capital gain tax for long-term capital gains. Those are on assets held, in this case investment assets, for longer than 12 months. When you hold an asset longer than 12 months and it appreciates and you sell it, you then realize a gain. That gain then is taxed, but it's taxed at a favorable income tax rate. So ordinary income tax rates go upwards of almost 40%. Those are ordinary income tax rates. Capital gains tax rates are typically 15 or 20%. You pay a capital gains tax rate of 15% if you are married, filing jointly, and your income is somewhere between roughly $80,000 and $500,000. You only pay 20% if you're married, filing jointly, and your income is over $501,000. This is for 2021. In addition, there is a so-called Medicare or Obamacare surcharge for couples, and I'm looking here, who are married, filing jointly, and who earn $250,000. So simply put, the rate that you pay for the gain that you've enjoyed is somewhere around 15, 20, maybe a little bit more than that, 3.8% more than that. But that's, in the big picture, not that bad when ordinary income tax rates, as I said before, they go upwards of 32% if you're earning up to $412,000, 35%, $628,000, and over 37% if you're earning more than $628,000. Okay, so with that background, how did we get to the point where so many clients had to realize significant gains in 2021? It really is driven by the spectacular performance of the equity markets in the years 2019, 2020, and 2021. In each of those years, the equity markets averaged more than 20% in terms of a return. And of course, here at Westover, our investment philosophy is to find the very best companies we can, to buy them when they put their price on sale, and to hold them for you. And so we were enjoying a wonderful return for each of you during those periods of time. The end result of that, however, is that there's effectively no losses that you can harvest in your portfolio to use as an offset to the gains that need to be realized when we are balancing your portfolio. And you say, well, why are we balancing your portfolio? Well, it's because your asset allocation calls for you to have a certain percentage of your overall portfolio in equities. It can be 50%, 65%, 80%. You're familiar with those numbers. It can be something else. And if the gains in the equities continue to grow and grow and grow, a portfolio is called for having 65% in equities may get to 70 or 72 or 73%. We've got to cut that back, and in the cutting, we realized some gains. So that's the first issue. The second issue was that 2020 was really a perfect storm. You may remember that at the beginning of COVID in March, the market tumbled, and it tumbled very precipitously, very quickly. Inside a period of 6 weeks, it fell 30+%. However, when it did that, we were able to sell equities to realize a loss. And then what the market did is it turned around and it bounced back up like a yo-yo, almost as fast as it bounced down. And as I said earlier, it ended up plus 20%. So for 2020, we were able to offset gains with the losses we could realize. And in 2020, you had very little realized capital gains. You're in for a shock, perhaps, in 2021 because using the same metrics and performance and approach, we didn't have any losses to take. So that's what's really driven the large capital gains you've realized and the accompanying tax that you're responsible for paying. On our end, we think we should have done a better job of notifying you about these gains. And so for that fact that we did not give you the heads up as much as we should have, we apologize, and we will do so going forward. So to better prepare you for what you might experience in 2022 and in the future, we are going to be posting a realized gains and loss report each quarter to your portal so that you can see your portal's realized gains and loss picture. This information can also be found on your portal under Reports, Transaction Reports, Realized Gains and Losses. And you can drill down into that if you're so interested to find your prior year's gains and losses and your year-to-date gains and losses by choosing the appropriate drop-down box. You can always find it daily as well by going to the same reports section and looking for realized gains and losses. Obviously, those realized gains and losses only pertain to taxable accounts, not to retirement accounts. And so to the extent that your gains or losses are in those retirement accounts, you don't have to worry about them. You only have to worry about withdrawals from IRAs and 401ks that are non-Roths and reporting ordinary income tax rates, ordinary income, and paying ordinary income tax rates on those. So anyway, I hope that's not too confusing. We're happy to answer any questions you may have. Sorry that it's coming as somewhat of a shock that you've had such a successful year and Uncle Sam wants to get into your pocket a little bit to enjoy your success. But like I said at the beginning, that's kind of a good problem to have in the big picture, and I hope you will agree. Have a wonderful weekend. It's Good Friday coming up and then Easter, and we look forward to seeing many of you early next week on April 19th at our Economic Summit. So take care.